If you want investment income to replace a paycheck, you have to understand one simple principle before anything else. A paycheck is not freedom. A paycheck is an agreement. You give your time, your energy, your attention, your body, and often your peace of mind to a system. In exchange, the system sends you money on a schedule that can work for a long time, but it has a weakness built into it. The money only keeps coming if you keep showing up. When I study money, markets, and people, I try to look at the machine underneath the surface. Most people look at income as something that comes from a job. I look at income as something that comes from assets. That distinction changes everything. If you make $80,000 a year from your job and you want to stop depending on that job, the math is not emotional, it is mechanical. You need your assets to produce enough income to replace the $80,000 you are earning from labor. That does not happen because you want it. It does not happen because you read a motivational quote. It happens because you convert saved money into productive assets. And those productive assets begin sending money back to you. That is the basic machine. With a job, you work first and get paid after. With an asset, you put capital to work first, and then the capital works while you are sleeping, thinking, traveling, recovering, or doing something more useful with your life. Most financial advice focuses on growing wealth. Put money into an index fund, let it compound. That is not wrong. I believe broad market ownership can be very useful. It gives you exposure to human productivity, innovation, and the long-term tendency of economies to grow. But growth and income are not the same thing. If your problem is, how do I build wealth over 30 years? Then a growth strategy can be enough. If your problem is, how do I create cash flow that can pay my bills without depending on an employer? Then you have to think differently. You need income. You need payments. You need assets that distribute cash in a way that can be used to cover real expenses. And I want to be very direct about this. It is not easy. It is not overnight. It takes sacrifice, capital, patience, and discipline. It often requires living below your means for many years so that your money can buy pieces of machines that pay you back. People like the idea of passive income because it sounds effortless. It is not effortless. It is front-loaded effort. You do the hard work first. You save, you learn, you take risk intelligently, you make mistakes, you improve the system, and only later does the system start producing income that feels passive. That is why I want to walk through the 5 asset categories I would think about if the goal were to replace earned income with investment income. I am going to move from the simplest to the more complex because that is how good decision-making works. You do not start with the most complicated thing because it offers the highest yield. You start with the thing you can understand, then you move outward as your knowledge and tolerance for complexity increase. The place I would start is with Treasury bonds. A Treasury bond is one of the simplest income machines in the financial system. You are lending money to the United States government, and in return the government pays interest. The reason people start here is not because treasuries will make them rich quickly. They usually will not. The reason people start here is because the structure is simple, the risk is relatively low, and the income is predictable compared with many other assets. When you lend to the United States government, the repayment depends on the government's ability to tax, borrow, and print money through the broader monetary system. If that system truly fails, the problem in your life will probably be much larger than one treasury position. That does not make treasuries risk-free in every possible sense. It means the default risk is generally low compared with lending to a private company, a borrower, or a speculative business. There is another advantage. The interest from treasuries is generally exempt from state and local income taxes. That can matter a lot depending on where you live. 2 investments can show the same stated yield, but after taxes one can be meaningfully better than the other. That is one of the most important things to understand about income investing. The income you keep is what matters. Not the income printed on a website, not the yield in a headline. The money you can actually use after taxes, fees, inflation, and mistakes is what matters. Treasuries can also be arranged to produce regular income. Some people buy them directly through Treasury Direct. Others use Treasury bond ETFs, which package Treasury bills or bonds into a fund that trades like a stock. A short-term Treasury ETF can be a simple way to get monthly income tied to short-duration government debt. In the example from the original framework, SCUV was used because it holds very short-term Treasury bills and distributes the interest. That kind of asset is not designed to create large capital gains. That is the trade-off. You may receive interest, but the principal itself does not normally grow in the way a great business might grow. If you lend $100, you are mainly getting interest on that $100. You are not buying a productive company that can expand earnings for decades. So the strength of this asset is also its limitation. It is stable, simple, and income-focused, but the returns are capped by interest rates. If the Federal Reserve lowers rates, the income from short-term Treasury instruments will likely fall. If inflation runs above your yield, your real purchasing power may not grow. And even if the asset is backed by the government, it is not the same thing as FDIC, insured bank deposits, that matters. A safe-looking asset can still have risks if you do not understand the exact mechanism. So in my mind, Treasury income is a foundation, not the whole house. It can provide stability, it can generate some income. It can reduce the emotional pressure that causes people to do foolish things. But if your goal is to replace an entire paycheck, you probably cannot stop there unless you already have a large amount of capital. That brings me to the next category, dividend. Paying ETFs. To understand dividend ETFs, you have to understand the basic economic logic of a dividend. A business earns profits. After paying expenses, taxes, reinvesting in growth, paying down debt, or making acquisitions, it may still have cash left over. One thing it can do with that cash is distribute part of it to shareholders. That distribution is called a dividend. If you own shares, you own a small claim on that business. When the business distributes cash, you receive your share. This is different from hoping the stock price goes up. It may still go up, but the income investor is asking a different question. Not only, will someone pay more for this asset later? But also, will this asset send cash back to me along the way? That question is powerful. But individual dividend stocks can be dangerous if you do not know what you are doing. A company can look stable until it is not stable. It can pay a dividend for years and then cut it when debt competition, bad management, or industry decline catches up with it. A restaurant chain can lose relevance. A telecom company can drown in debt. A bank can look safe until depositors start leaving. A retailer can pay a dividend right up until the business model breaks. This is why a dividend ETF can make sense for many people. Instead of relying on one company, you own a basket of companies. If one company weakens, the fund can reduce or remove it and replace it with another. That does not eliminate risk. It spreads risk. There is a big difference. One example is a dividend aristocrat fund. These are companies that have paid and increased their dividends for a long period, often 25 years or more. A fund like that is not trying to find the most exciting companies in the world. It is trying to find companies with a long record of returning cash to shareholders. That discipline has value. It forces the portfolio toward companies that have survived different environments: inflation, recessions, rate cycles, market panics, management changes, competition. A business that can keep raising dividends for decades usually has something going for it. Maybe a strong brand, maybe durable cash flow, maybe pricing power, maybe a conservative culture. But again, you have to be careful. A long dividend history does not guarantee the future. The world changes, industries change, debt levels change, consumer behavior changes. A rule that worked in the past can fail when the underlying machine changes. Another example is a broad high dividend ETF focused on U.S. companies. A fund like SAG, for example, gives investors exposure to a group of companies selected around dividend and quality characteristics. The attraction is obvious. You get broader exposure, you get dividend income. You do not have to research every individual company every day. But there is still a principle I would never ignore. Do not buy yield alone. High yield can be a signal of opportunity. It can also be a signal of danger. If a fund or stock yields much more than comparable assets, you have to ask why. Sometimes the market is giving you a bargain. Sometimes the market is warning you that the payout may not be sustainable, or that the underlying asset is deteriorating. Income investors often make the mistake of reaching for the highest number. That is not investing, that is yield chasing. And yield chasing often ends badly because the investor focuses on the cash payment while ignoring the asset producing the payment. A strong income asset has two parts, the cash flow and the durability of the source. You want both. There is also an international version of this idea. International dividend ETFs can give exposure to companies outside. That can matter because different countries grow at different speeds, trade at different valuations, and pay different dividend rates. Some international markets have companies with higher yields than U.S. markets. Some are tied to faster growing populations. Some benefit from currencies, commodities, banking systems, or industries that do not move exactly like the United States. But international investing carries its own risks. Currency risk, political risk, less stable regulation, different shareholder protections, different accounting norms, different tax treatment. So again, the principle is not international is better. The principle is diversification can be useful when you understand what you are buying. Then there are real estate ETFs, especially REIT ETFs. A REIT is a real estate investment trust. Instead of buying a building yourself, you buy shares of companies that own real estate or real estate-related assets. Some REITs own actual properties, apartments, warehouses, offices, medical buildings, hotels, storage facilities, data centers, and other physical assets. Other REITs are mortgage REITs. They invest in loans and mortgage-related securities rather than the buildings themselves. These are very different machines. A property REIT's performance depends on rents, occupancy, property values, financing costs, and management quality. A mortgage REIT can be much more sensitive to interest rates, leverage, spreads, and credit conditions. Mortgage REIT yields can look very high. That does not automatically mean they are better. It can mean the risk is higher, it can mean the cash flow is more fragile, it can mean the asset is more volatile. So when I look at dividend ETFs or REIT ETFs, I try to think in systems. What is the asset? What produces the income? What can break the income? What happens in recession? What happens if rates rise? What happens if rates fall? What happens if credit tightens? What happens if the tenant base weakens? That is how you protect yourself from being seduced by a number. A dividend yield is not a promise. It is an output of a system. Understand the system. Once you move beyond securities that trade in the market, the next income asset becomes more real, more powerful, and more demanding, real property. Real estate is one of the classic ways people build income because it combines several features that can work together. You can buy a hard asset, you can collect rent, you can benefit from leverage if used responsibly, you can receive tax advantages. And over long periods, the asset may appreciate if bought well and managed properly. But real estate is not magic. Bad real estate can destroy capital. Bad tenants can destroy cash flow. Bad debt can destroy sleep. Bad markets can trap you. And bad assumptions can turn what looked like passive income into a second job with worse hours. The basic idea is simple. You buy a property not to live in, but to rent to someone else. The tenant pays rent. That rent must cover the property taxes, insurance, maintenance, management, vacancy, financing if you have debt, and still leave cash flow for you. That leftover cash flow is what matters. Not the rent number, not the purchase price alone, not the story. The net operating income. Most beginners look at rent and get excited. Professionals look at expenses and get serious. If a property rents for $2,000 a month, that sounds like $24,000 a year of income. But that is gross income. It is not yours yet. Taxes come out, insurance comes out, repairs come out, management comes out, vacancy comes out, capital expenditures come out, debt service may come out. Only after that do you know what the property actually produces. This is where many people learn the first hard lesson of real estate. Revenue is not profit. If you buy a $200,000 property and after expenses, it produces $10,000 a year in cash flow, that is a 5% cash return if you paid all cash. Is that good? It depends. Compared with what? Compared with a Treasury yield, compared with a dividend ETF, compared with the risk. Time, illiquidity, concentration, tenant risk, and repair risk. That is how you have to think. The opportunity cost matters. The risk matters, the work matters. For some investors, 5% on a property is not enough. They might need 7% or more to justify the complexity. But the number you require depends on your market, your goals, your financing, your tax situation, and your willingness to do the work. And make no mistake, real estate requires work. Even if you hire a manager, you still have to manage the manager. You still have to buy correctly. You still have to understand neighborhoods. You still have to estimate repairs. You still have to prepare for vacancies. You still have to avoid fooling yourself with optimistic spreadsheets. The phrase that ruins people in business and real estate is, "How hard could it be?" It can be very hard. That does not mean you should avoid it. It means you should respect it. Real estate can be powerful because it gives you a tangible asset. You can see the land, the building, the roof, the windows, the plumbing, the structure that matters psychologically. It also matters economically because people need places to live and businesses need places to operate. But tangible does not mean safe at any price. A real asset bought badly can still be a bad investment. Real estate also has tax features that can be very attractive. Depreciation can reduce taxable income because the tax code recognizes that a building wears down over time. There may be deductions for ordinary and necessary expenses related to managing the property. A real estate investor might show less taxable income than actual cash received because depreciation reduces the reported income. That can be powerful, but it can also be misunderstood. Tax benefits should improve a good deal, not rescue a bad one. If the only reason a property works is because of a tax deduction, I would be careful. The economic machine should work first. The tax treatment should be secondary. Real estate can help replace a paycheck, but it is not usually the easiest path. It requires capital, discipline, good numbers, and emotional control. It is illiquid. You cannot sell a house in 5 seconds like you can sell a stock. If you need cash quickly, real estate may not give it to you. That is why, in a well-designed income system, real estate can be one sleeve, not the entire system. The next asset category is a business. A business is one of the most powerful income-producing assets in the world because it can create profits independent of your wage. But it is also one of the hardest. To understand the business asset, you have to separate wages from ownership. An employee gets paid for doing a job. An owner receives the profits after the business pays its expenses. Those are different positions in the machine. You can be both. You can work in your business and own your business. Many founders do. But the goal, if you are trying to create income that eventually replaces a paycheck, is to build or buy an ownership claim that produces profit even when you are not doing every task yourself. That is much harder than it sounds. A small business often depends on the owner. The owner sells, manages, hires, fires, negotiates, handles customers, solves emergencies, and carries the stress. In that case, the business may not be an investment. It may just be a job you bought for yourself. That can still be good. But you should be honest about it. If the business only works when you are inside it every day, it has not replaced your paycheck. It has changed who signs the paycheck. To make a business into a more passive income asset, it must have systems, people, margins, customer demand, controls, and resilience. It must operate without your constant attention. That takes either a lot of money, a lot of skill, or a lot of time. Often all three. Some people start businesses from scratch. That path has the greatest creative control, but also the highest uncertainty. You are building the product, the customer base, the processes, the culture, and the profit engine from zero. Others buy existing businesses. That can reduce some uncertainty because the business already has customers, revenues, employees, and history. But buying a business introduces different risks. Are the numbers real? Will customers stay after the seller leaves? Are employees loyal to the company or only to the previous owner? Are there hidden liabilities? Is the industry declining? Is the profit dependent on one customer, one supplier, one platform, one person, or one favorable condition? A business can look profitable on paper and collapse after acquisition if the buyer does not understand what actually creates the profit. That is why I would never look at a business only by asking how much cash flow does it produce. I would ask, how fragile is that cash flow? A fragile business at a high yield is dangerous. A durable business at a fair yield can be excellent. The internet has made business ownership sound too easy. Buy a car wash, buy a laundromat, buy a route, buy a small service company, hire a manager, collect cash. Sometimes that works, often it does not. Not because the idea is wrong, but because business is a system of people, incentives, operations, competition, maintenance, and constant adaptation. How hard could it be? Harder than the spreadsheet says. But for the right person, a business can produce not only income, but wealth, tax advantages, control, and purpose. It can teach decision, making better than almost any asset because reality gives feedback every day. Customers either buy or they do not. Margins either exist or they do not. Employees either perform or they do not. Cash either lands in the bank or it does not. There is less room for fantasy. That is why business ownership is powerful and dangerous. It gives you control, but it also gives you responsibility. The fifth category is peer-to-peer lending, or more broadly, private credit. This means you lend money directly or indirectly to borrowers who need capital. The borrower might be an individual, a real estate investor, a small business, or some other party. In return, they pay interest. The attraction is obvious. The yields can be higher than government bonds, sometimes much higher, 5%, 10%, 15%, even more in certain private lending situations. But yield always comes with a reason. If someone is willing to pay a high interest rate, you have to ask why they cannot borrow more cheaply elsewhere. Maybe the opportunity is legitimate and time-sensitive. Maybe the borrower needs speed. Maybe the loan is backed by strong collateral. Maybe the bank system is too slow, or maybe the borrower is risky. Maybe the collateral is weak. Maybe the loan documents are poor. Maybe the platform is not doing enough underwriting. Maybe you are being paid high interest because your principal is in real danger. This is why I would be very careful with private credit unless I understood the collateral, the borrower, the platform, the loan structure, and the recovery process. If something goes wrong, if I were lending privately, I would prefer collateral. Real estate collateral is often used because if the borrower defaults, there may be a property to recover against. Even then, recovery is not simple. It can require legal action, time, costs, market risk, and a sale process. A loan can look secure until you have to enforce it. That is the difference between theoretical safety and practical safety. Peer lending platforms can make access easier, but easier access does not mean lower risk. In fact, sometimes easier access allows people to enter markets they do not yet understand. That is a recurring danger in investing. A product becomes easy to buy before the investor understands how it can fail. Private credit can be a source of income. It can be part of a diversified income strategy, but I would not treat it as a simple substitute for a Treasury bond. It is lending to weaker or more specialized borrowers. The spread exists because the risk exists. Respect the spread. Now let me bring the whole machine together. Treasuries can provide stability and relatively simple income. Dividend ETFs can provide market-based income from baskets of companies. Real estate can provide rental income, hard assets, and tax features. Businesses can provide profit ownership and control. But with high complexity, private credit can provide higher interest income, but with meaningful default and liquidity risk. The mistake is to think one asset solves everything. It does not. Each asset solves one problem and creates another. Treasuries solve simplicity but limit growth. Dividend ETFs solve diversification but expose you to market risk. Real estate solves tangibility and cash flow but creates illiquidity and operational work. Businesses solve control and upside but create complexity and failure risk. Private credit solves yield but creates underwriting and default risk. This is why the real skill is not finding the asset with the biggest promised return. The real skill is building a system that matches your needs, temperament, capital, time, and risk tolerance. If you need income soon, you think one way. If you have 20 years, you think another way. If you cannot tolerate volatility, you should not build a system that depends on volatile assets. If you hate operations, you should be careful with real estate and small businesses. If you do not understand credit, do not chase private lending yields. If you do not understand taxes, bring in someone who does. That is not weakness. That is good risk management. People get into trouble when they confuse income with safety. An asset can pay income and still be dangerous. A high dividend can be cut. A rental property can go vacant. A borrower can default. A business can lose customers. A fund can decline in price. A bond can lose purchasing power to inflation. Income is not enough. Durability matters, liquidity matters, tax treatment matters, inflation matters, concentration matters. Your own behavior matters most of all, because the best asset in the world can become a bad investment if you buy it with borrowed money, panic during volatility, fail to understand it, or put too much of your life into one fragile bet. The goal is not to never work again in the childish sense. The goal is to stop being forced to work, because your bills depend entirely on your labor. That is a much more serious goal. It is not about laziness. It is about resilience. If your income comes only from your job, one bad event can change your life. A layoff, a health issue, a recession, a bad boss, a dying industry, a personal emergency. If your income comes from multiple assets, the system becomes more resilient. One stream can weaken while another holds. One asset can underperform while another pays. One market can be bad while another creates opportunity. That is the real reason to build investment income. Freedom is not having no responsibilities. Freedom is having enough independent sources of cash flow that no single person, employer, market, or institution can control your life completely. But to get there, you have to be honest about the math. If you spend $80,000 a year, you need enough capital producing enough after-tax income to cover $80,000 a year with a margin of safety. If your assets yield 4% after taxes, then $80,000 of income requires roughly $2 million of productive capital. If your assets yield 8%, the required capital is lower, but the risk and complexity may be higher. That is the trade-off. There is no magic. There is only capital, yield, risk, taxes, inflation, and behavior. People want shortcuts because the math can feel discouraging, but the math is also liberating. Once you understand the machine, you can start building it, save more, spend less than you earn, buy productive assets, reinvest income before you need it, avoid stupid debt, avoid emotional speculation, avoid pretending complexity is sophistication, avoid confusing popularity with quality, build slowly. Then one day, the income from your assets is not symbolic anymore. It pays a bill, then another bill, then a month of expenses, then several months, then maybe your entire life. That is how the transition happens. Not all at once, gradually, then suddenly. The early years are the hardest because the income is small and the sacrifice feels large. But compounding has a strange psychological effect. At first, nothing seems to happen. Then the assets begin to matter. Then the income begins to matter. Then the system begins to support itself. That is when people finally see what they were building. They were not just buying funds, bonds, properties, or business. They were buying back pieces of their life. I would never tell someone that any one of these assets is right for everyone. Each person has different circumstances, tax situations, family needs, time horizons, and risk tolerances. But I would say this: if you depend entirely on your paycheck, you are more fragile than you think. If you own income, producing assets that you understand, you are building resilience. The world will always change, interest rates will change, taxes will change, markets will rise and fall. Real estate cycles will turn, businesses will boom and struggle, credit will expand and contract. You cannot control all of that. You can control whether you learn the rules of the game. You can control whether you build assets instead of only earning wages. You can control whether you chase the highest yield or build the strongest system. You can control whether you prepare before you need the income or wait until the job is gone and the pressure is already on you. That is the principle I would leave you with. Do not ask only, how do I make more money? Ask, what kind of machine am I building? And will that machine still work when I am not working? That question is the beginning of financial independence. And if you answer it honestly, you will stop seeing income as something that comes only from a job. You will start seeing income as something that can be designed, built, protected, and improved. That is how you replace a paycheck. Not with a fantasy, not with a promise, with assets, with systems, with discipline, with the patience to build something that pays you long after the original effort has been made.